The last calculation we need to be concerned with in order to determine our weighted average cost of capital is the cost of common stock. So this is the cost of capital from common stock, and it's also the rate that we use to discount our expected dividends when we did stock valuation back in Chapter 7. So there's a couple of different forms of common stock. We've got current stock out there in the market that existing shareholders possess, and then we also have the ability to issue new common shares out in the market with the help of investment bankers. So what we really have is we have a cost of retained earnings and we have a cost of new common stock issues. So recall, retained earnings are just the net profits of a company after all expenses and taxes and interest have been paid, and those profits are retained by the company in the form of retained earnings on the balance sheet, but also a portion of those earnings can be paid out in the form of dividends to existing shareholders. So we have, again, what we can calculate really two different forms. We can calculate a cost of retained earnings, paying dividends out of our operations and net profit of the company. And then we also have the cost of new common stock issues. Now, when it comes to applying one of these to the weighted average cost of capital, we're typically going to be more concerned with or focused on using the cost of new common shares towards the weighted average cost of capital. But we will calculate a cost of retained earnings as we go in order to see what the differences between the two are. Again, paying dividends out of the profits and normal operations of the company versus having to pay dividends on new common stock issues. We have two methods to estimate the cost of common stock. The first one is the constant growth model, also known as the Gordon growth model that we worked with in Chapter 7. And recall that that model used a formula where P price of the, or current price of the common stock should equal the next year's dividend divided by R minus G. So R was our required rate of return, and G is the expected growth rate of the dividends. Since we are concerned with the required rate of return, we can use that formula and solve for R so that we have R equals the next year's expected dividend divided by the current price of the stock, and then add the growth rate in decimal form. So again, to make sure that that is clear on the calculation, it's going to be the next year's dividend divided by current price, and then we add the growth rate in decimal form. So for example, a 7% growth rate would be 0.07 entered here for G. We had a few problems back in Chapter 7 where we had to solve for the required rate of return as well as the growth rate using this model, and we're just using algebra to plug the numbers and compute for a different variable other than price. And so the same thing applies here, although we're just shuffling the formula around up front before we plug in numbers to solve for R. Now, note that this reflects the cost of existing shares of stock because we're using P, which is the current price. So this formula would really be applicable in a cost of retained earnings approach, not in an approach where we're trying to calculate the cost of new common stock issues. To find the cost of new stock issues, what we're going to do is use the same formula, but we're going to substitute P price for N, and N is the share price that we're going to expect to receive or sell into the market on a new issue, net of any flotation costs, which are costs that are going to be incurred from the use of investment bankers to put together the new issue, and underpricing, which is just basically having to sell the new shares for a price that is less than what the current shares are selling for in the market, the current existing shares are selling for out in the market. So solving for R in this case, we're still going to have that next year's expected dividend, and we're going to divide that by this new variable n, which is again the net price of the new shares, net of flotation costs and underpricing, and then we're going to add to that the growth rate, same growth rate of expected dividends out in the future. So once again, just to make sure that that formula is clear, we're going to have the next year's expected dividend. We're going to divide that by n, share price net of flotation costs and underpricing, and then we're going to add to that the dividend growth rate in, once again, decimal form. Now, one thing to note is that the cost of retained earnings versus the cost of new common stock issues, the cost of new common stock issues will always be higher than the cost of retained earnings, and really that is just because of the fact that we have flotation costs and underpricing to factor into the calculation for the rate. So let's look at an example now. So we have a firm that has common stock out in the market that currently sells for $65. They expect to pay a dividend of $7 next year, $7 per share. The dividends have been growing at an annual rate of 9%, and that's expected to continue out into the future. To sell the new common stock shares, the firm must underprice the stock by $6. So that means that based on market conditions, the new shares would really sell at $59 instead of $65, and there will be flotation costs of $7 per share that will be incurred by the investment bank that put the issue together. So what we'll do is we're going to solve this problem for both a cost of retained earnings as well as a cost of a new common stock issue. So if we're going to solve for cost of retained earnings, we're really just going to use the regular Gordon growth model formula to determine what our R is. So in this case, what we're going to have is R that is equal to, we have R equal to the next year's expected dividend, which says 7% in the problem. We're going to divide that by the current market share price of $65. We'll add to that our growth rate, which in this case is 9%. So we put that in decimal form, 0.09. And when we calculate that out, what we come up with is a cost of retained earnings that's equal to 19.77%. Okay, so the other thing that we'll want to look at is the cost of new common stock issues. So, using the numbers in this example, what we would have is a required rate or cost of common stock that would be equal to the same next year's expected dividend of $7 a share, and we're going to divide that by the current share price of $65. However, we need to deduct from that the underpricing. So again, in order to sell the new stock shares, the new issues out into the market, we need to sell them for lower than what the current stock price is. So we would need to actually sell them for $6 less. So we're going to subtract 6 from the current share price. Then we also need to factor in flotation costs. In this case, they're going to be $7 a share. And then from there, we'll add the same growth rate of dividends expected in the future, which is 9% in decimal form, 0.09. And then when we calculate that out, we come up with a 22.46 rate. And as expected, as we noted earlier, the rate on the cost of new common stock is higher than the rate that is expected on the or calculated for cost of retained earnings, and it really just has to come down to the fact that we have to factor in the flotation costs and the underpricing on the new share issue.